Candlestick charts are popular with traders who want to identify the market's current sentiment. Additionally, some traders look for chart patterns and specific formations in an attempt to help identify bullish and bearish signals. These patterns are commonly used by short-term traders, but they are also used by long-term investors. In this video, you'll learn about one category of chart patterns: continuation patterns. These provide signals that the current trend may continue. Trading is sometimes compared to a battle between the bulls and the bears. Like any battle, there are surges, counterattacks, and retreats. Some traders struggle to determine when one side may be getting ready to attack or preparing to retreat. This is where candlestick patterns may help. For example, the Rising 3 Methods pattern is a bullish continuation pattern. It suggests that a counterattack by the bears has failed to significantly impede the advance of the bulls and projects a continuation of the bullish trend. Here's what this pattern looks like. It begins with a long white candle, indicating a bullish rally. The bears then counterattack, pausing the bulls' advance and causing the next 3 trading periods to stay the same or to even decline slightly. But then the bulls surge forward, and another long white candle appears. Once this 5th candlestick appears, many traders might consider this to be confirmation that the uptrend will continue. Therefore, traders may use this pattern to better determine potential entry points. The Rising 3 Methods can also be flipped to track the bulls and the bears during a downtrend. The Falling 3 Methods pattern suggests the bulls' counterattack quickly failed during a longer-term bearish trend, hinting that the trend will continue downward. This pattern goes through the same motions of a surge, followed by a retreat, and ending with another surge. Now let's look at another continuation pattern: a window. A window is a gap in price. This pattern suggests sentiment was so strong the price had to make a big jump to find enough traders to fill the orders. Whether bullish or bearish, a window is a sign that sentiment is very strong and that the current direction is likely to continue. Other candlestick continuation patterns are also characterized by a jump in price. One example of these is the separating lines pattern. Let's look at a bullish example. The pattern begins with a gap up at the opening price. This gap is then filled in as the price sells off and closes lower. However, the next candle opens at very nearly the same price as the previous day's open and then rallies higher, forming the separating lines pattern. Like the other patterns we've reviewed, this pattern suggests that the bullish trend is likely to continue. This shows that the bulls and the bears were fighting over the same battle lines. However, one side momentarily surged and then quickly fell back. Now onto our final continuation pattern, the kicking pattern, which combines the window and separating lines patterns. This time, let's look at a bearish example. The pattern begins when a single candle moves against the trend. However, in the next trading period, the opening price gaps below the opening price of the previous day. This results in a window. Then the trend continues with another long candle. The large swing in direction shows the degree to which sentiment is dominating the market. Surges, counterattacks, and gaps can help you identify the current sentiment for a short-term trend. The ability to recognize these patterns can help traders determine potential entry and exit signals. However, candlestick patterns are usually just one part of a trading strategy. Traders commonly use them in conjunction with support and resistance or other technical tools to determine trading signals.